That's a long intro, that song, isn't it? Which is good because I was slightly disorganised getting myself up here, but not quite as disorganised as Tim and Ian down the front here. But that's okay. You got in here and you found a seat, and that's important. I've actually brought my lunch in. I was so busy chatting with people outside trying to get the latest information for you for this next session that I once again gave up and I brought my lunch in with me. That's okay. If you feel like you need seconds, feel free to go out and come back, but not while our next presenter, our first presenter in this session is coming up here. Christopher Byrne, do you want to come up and join us? Have a look at this young fella here. What do you reckon his original trade is? He's a mild-mannered electrical engineer. That's what he started off as, and he started working in coal mines here in New South Wales?
Queensland.
Up in Queensland. And he was doing that for a while, and while he was there he had a bit of an epiphany and he got bitten by the exploration bug, and he decided his exploration mineral of choice should be gold and maybe copper. And as luck would have it, he's got a mate from high school days who was a very talented geologist, and the two of them put their head together and they said, bugger it, we can actually do this ourselves. We don't have to work for someone else. We can do it ourselves. We have the talent and the skills. And they aimed for success. They've achieved it. They've got two projects. One of them, it's a greenfields one, and it was recently signed Newmont onto it, and that's pretty good. That's pretty impressive. And they're heading for the same. They're heading to replicate that with their second project. So let's hear all about Legacy. Would you please make Christopher very welcome?
Well, thanks very much for the introduction. It's a real pleasure to speak today at the RIU conference. We're a gold and copper exploration company solely based in New South Wales. So we've got a package of 7 tenements covering close to 3,000 square kilometres. So one of the bigger land ownings in the region. In terms of the jurisdiction, for those that don't know New South Wales or the Lachlan Fold, it's Australia's premier porphyry copper gold country, home to Australia's largest gold mine, which is the Cadia Ridgeway Newcrest deposit, as well as some other significant mines and operating assets around the jurisdiction. We've got 7 tenements, and you'll see a strong focus in our portfolio on copper and gold. We're very long on those two commodities. We think that there's obviously good, strong gold price at the moment, but we see a real future in copper as a real key critical component in the decarbonisation and a significant future demand for those assets. Black Range and Ballura, they're our two flagship projects that we're progressing at the moment. As was mentioned, we signed a deal with Newmont to progress our Ballura project last month, so I'll run through that. But we're quite excited about those two types of systems, low sulfidation epithermals, and they represent significant value for shareholders. Brief company overview. We're quite a small team operating out of central New South Wales, so we don't have a corporate office in Sydney. David Carlin, Doug Menzies and Matt Wall as our non-exec directors, and Tom Wall and myself as the management. So Tom and I are down at the booth today. We've got some dual core and some rocks, so if people are keen to come down and see, those would be happy to run through what that looks like and what that emerging discovery at Ballura looks like as well. Just touching on the market cap, hovering around 13 mil, we think that presents a fantastic buying opportunity for shareholders. Hopefully by the end of this presentation I can demonstrate that the blue sky potential we see in some of our assets and just what that may translate to in terms of that shareholder growth. So Ballura, I'll run through this project. It's an emerging district scale low sulfidation epithermal. So as mentioned, Tom and I, we pegged this ground about 2.5 years ago. So it cost us $0 to acquire it. And in 2 years, we've added some significant value to it, to the point that we attracted the attention of Newmont, who have farmed in. So we see that as a great deal for our shareholders, provides significant funding. It's a discovery-focused joint venture. So what we see from that is an attention to a program of works that's going to realise potentially what we're looking for is a tier 1 gold deposit there. Importantly, at the back end of the agreement is this carried through to production. So there's a financing option there that Newmont provide for us to take up at our election, which would see us owning 20% of potentially a Newmont-sized mine. So we see that funding as being great for shareholders in terms of providing security and surety to progress that project forward. In terms of the project, Ballura, it's a district scale. We've pegged, virtually the entire district there, 330 square kilometres. The main area of interest is this vein field. When you talk about a 30 square kilometre vein field, you're talking about a globally significant system there. So that's epithermal veins mapped at surface, untested potential. When we picked it up, this project had one drill hole for every 75 hectares at an average depth of close to 90 metres, so very untested. And we've only just ticked over 5,000 metres of drilling. So it's an extremely early greenfield project. There's high grades, and importantly, it's a preserved epithermal system. And I'll run through the drill results that we put out today, which sort of confirm our initial interpretation that we are looking at a preserved, large-scale, low sulfidation system. So this is the diamond drill results that we did earlier this year. We put out some fantastic looking core. This vein field had never had a single bit of diamond drilling into the low sulfidation veining, so it was a real technical breakthrough doing that drilling. Core textures and textural observations are key in understanding these types of mineral systems. You couple that with the grade, the best intercept that we got, 13 metres at 4.5 grams gold equivalent, including a high grade zone of 6 at 8 from a very shallow 57 metres. That's an extremely encouraging intercept. That sits above what we interpret to be a high grade shoot. And as people know, shoots in these epithermal systems, that's what you're trying to target. The drill campaign, from some very wide space drilling, we think we snagged at least 3 of these shoots. And this is in across 2 kilometre strike of veining, again in that mapped 30 square kilometre vein field. So we see a huge room for growth on this project. This sort of helps contextualise that success in that drilling and what that hole looks like. We're calling it the blue cap shoot, 6 metres at 8 at a 50 metre depth profile. We're seeing very high levels of antimony in there. And if you look at the epithermal system model, which is just a very textbook model on what these types of systems, form and what to expect from them, they're dominated by a consistency in grade and mineralization, and that's extremely important to sort of place yourself in the system. So we're sitting in the top levels, the chalcedonic superzone. We've got that high levels of mercury. We're getting the good grades. If you were then to look at that depth profile from a very well-known low sulfidation system up in Queensland, the Vera shoot, and you look at that 3 metres at 5, 6 at 8, and 2.7 in that same 50 metre depth profile at Pajingo, you can certainly see that the results that we've got put us well and truly in the money for something that's going to grow out when we start to drill deeper and test those boiling zone targets. That just puts that Vera shoot into perspective across that vein strike. That Vera shoot is 500,000 ounces. So you stack up these shoots and all of a sudden you've got a significant epithermal system on your hands. Where this sits in terms of a globally, I mentioned it being a globally significant project. Obviously, there's good endorsement from Newmont that they agree with that proposition, but it's of similar size to multi-million ounce vein fields found globally. We're very early stage, as I mentioned, but the mapping that we've done to date certainly stacks the system up from a scale potential. The blue that you can see in our Ballura vein map there, they're the veins that have been tested to date, very wide space drilling. So we've really done around 10% of the known epithermal veinings in these wide space drill holes there. And you can just point out, that Vera shoot in the Pajingo vein field system as well. So when we were realising that Ballura was going to be a pretty special system, we started to look around New South Wales, and our thought process was there has to be at least another one out there. We picked up Black Range. It's another low sulfidation epithermal. It's about 3 times the size of Ballura, so it's huge. I think it represents about half the size of the ACT from a land footprint perspective. So it's a massive, massive system. We really like it. It's 65 Ks from Ballura. Again, we're seeing all the right ingredients that we saw at Ballura. Preservation, so large silica sericide alteration. We've got massive strike of epithermal occurrences up to 30 Ks. Untested. So the last real work that was done was Newcrest in 1992 at Sugarbag Hill. And for those that know Newcrest in 1992, they made a pretty significant discovery in New South Wales, which was Cadia. So they dropped this ground after that Cadia discovery, and there's been no on-ground exploration done at that prospect since. Newcrest, before they left, dated Sugarbag Hill to be the same mineralisation age as Ballura. So now we've got 2 systems in the same rocks, in the same jurisdiction, They share a very similar geological and tenement history, which is why we still believe the opportunity exists. We sort of demonstrated that at Ballura, and we're expecting that to sort of come true, hopefully at Black Range. What it comes down to is lack of drilling, no discovery. I talked about that scarce drilling at Ballura. I think at Black Range, it's about one drill hole every 1,700 hectares. So completely untested, no systematic work done, no modern geophysics or geochemistry done. So you're talking very limited work and a very limited scope from, I guess, a bunch of geologists in the early 80s, late 80s, early 90s that were really looking for not this type of deposit or system. What we saw for Ballura and Black Range was major companies holding these tenements and being distracted by other successes. The Cow Mine and Ballura were held by North Limited, who turned into RIU at the same time as the two big epithermal systems. With the discovery success at Cow, North Limited walked away from Ballura. Cow grew to a 15 million ounce low sulfidation epithermal system. Again, at Black Range, you had another company, Newcrest, with a company making discovery, Acadia, walk away and leave the ground completely untouched. So we see that as a great opportunity for our shareholders. We're really excited because both of those tenements present a lot of value that can be done for very little cost. So we're talking rock chips, boots on ground exploration. That's how these projects are successful, is really spending the time to do the systematic work, consult with the right technical experts. Ballura was a breakthrough for Legacy, and it was a real technical academic breakthrough for the Lachlan Fold Belt as well. That system is places in the Silurian Devonian age, places it as one of the world's oldest preserved epithermal systems. So that it's a globally significant project from that preservation perspective. Being dated to be of the same age, we're obviously looking again to replicate that success, and hopefully we'll get another Ballura 2.0 from Black Range. I'll briefly touch on two of our other projects, which are also in our current pipeline, and it just sort of demonstrates the depth that this company has in terms of these projects. These were both pegged by Legacy, again, free ground, Cobar back in 2017. We saw that as a great opportunity in the Cobar Basin. After we moved in, you had companies like Sandfire peg the ground around us. So looking for the same type of Cobar type deposits. We're right in the heart of the basin, untested anomalies, downstrike from the CSA mine, sitting off the major Mert fault there. Rockley, we're looking at, this is porphyry country in central New South Wales. It's about 50 k's from Cadia. And again, we're looking at another tenement that sat with Alkane, didn't do any on-ground exploration in that part of the tenement. There hasn't been a single drill hole there deeper than 18 metres. And what we're starting to do is find these high-grade rock chips, the right pathfinder elements. We've got this circular donut magnetic feature, classic porphyry signature right in the middle of the tenement. Lastly, I'll run through Earth AI. We did another deal with a company similar to Newmont in a sense, but with it's called a strategic alliance. And what that allows Earth AI, who are an artificial intelligence company, is working on two of our other projects. They generate targets. They've got their own drill rigs. They test those targets. What that means for shareholders, again, is another company that's spending money on our ground that we don't have to. We get the exposure discovery to it as well, and it allows us to focus on our primary projects at Black Range and Ballura. So in terms of the program, we're well funded for what we need to do for the remainder of the year. We've got Newmont and Earth AI. That partnership funding totals close to $20 million over 8 years for those parties that they can choose to earn up into. And then we've got, as I said, boots on ground, reconnaissance rock chipping at Black Range and Rockley. So what that means for shareholders is good continuous news flow. We're an active explorer. We put some results out today, so I encourage people to read those that announcement and come have a chat to us about it. But we're expecting it to be a pretty exciting year, particularly as we ramp up that discovery campaign with Newmont at Ballura. So to sort of summarise, there are a lot of great companies out today, and this is a great session. So it's a real honour to be presenting amongst some really good companies out there, but we see it as a really sound investment decision for new shareholders coming on. We've got the emerging discovery at Ballura. We're hoping that translates into something that's going to be quite a large system. We've got Black Range, where we're looking to replicate that success and just demonstrating we're in a tier 1 jurisdiction. We've signed on a tier 1 partner, and we're looking for tier 1 size targets. So thanks all for your time.
Thank you, Christopher. Well done. Just a short public service announcement, if I may. I'm also the hub of information for you all. We've got 2 pairs of reading glasses that have been handed into our registration desk, some black ones and some blue ones. So if you go and see Andrea and Prue up there, they will hook you up with those. Also, let's have a look at the results from the poll. The question that I asked you before we went to the break was, what sector do you think will see the most consolidation over the next 12 months? What sector do you think will see the most consolidation over the next 12 months? Excuse me. That, of course, is the question for this session, and I will reveal the answer to you when you put it down. It's been a long day and a half so far, so don't you laugh at me. I'll have you up here. What's your name? Greg, nice to meet you, sir. Investor? What's your favourite at the moment? Have you got a pick? Really? Okay. All right, we'll wait. We'll see how you go. Right, so that's your question. Can you flick on that one for us and get involved in that? I think also I have a silver bar milling around somewhere in the room as well that I want to show you, because that is the incentive to come and hear a certain presenter tomorrow morning at 9:15. It doesn't look like we need much incentive to see this next fella. Come up here, Dougal Elder. Dougal's going to have a chat with us, and Dougal, of course, is from Sayona Mining, powering the clean energy revolution in North America with a lithium resource base. In March, 6 weeks ago, 8 weeks ago, they restarted their lithium production at the North American lithium operation in Quebec, Canada, and they've got more expansion plans, so they've got a very big year ahead. And I also thought what was interesting was you're now valued at a $2 billion operation, which isn't bad, considering it was only 2 years ago that you picked up a certain little plant for $100 million. How have they done it? You're going to reveal that, aren't you? What's the plans to get even more? You're going to reveal that too. Would you please welcome Dougal, everyone?
Thanks very much for that very warm welcome, Chrissy. It's great to be here in Sydney today, meet with so many investors, and I look forward to sharing with you some exciting news that we've got coming ahead for Sayona in 2023. So the headline for us is that Sayona Mining is North America's newest lithium producer, the only major producer of hard rock lithium in North America, and will be so for some time to come. Production commenced at our flagship North American lithium plant in Quebec, in Canada, in March of this year. So we've been going for about 2 months. NAL is on a path to ramp aggressively to an annual run rate of 226,000 tonnes of concentrate per annum, or around 600 tonnes of concentrate per day. We think NAL will get there around October of this year. And to put that in perspective, the rate that we achieved in March of this year was around 150 tonnes per day. So the ramp up is on track, and NAL is performing very well so far. Snapshot for Sayona: we're an ASX listed emerging lithium producer. We have a market capitalisation of $1.8 billion, part of the ASX 200 index. We have a cash balance at the end of March of $100 million, and more importantly, we have no debt on the balance sheet at this point in time. Experienced board and management team leads Sayona, led by our Managing Director, Brett Lynch. Each of our directors individually have over 30 years of experience across multiple sectors, across coal mining, marginal coal mining sectors in Queensland, lithium development in the Pilbara, in terms of development of ore bodies and concentrators, as well as various other sectors such as chemicals sectors. So a lot of experience on our board to lead Sayona forward. ESG is very important to us, given the role that lithium will play in the decarbonisation transition of North America. We take ESG very seriously at Sayona, and that's anchored by our access to the Government of Quebec's clean and cheap hydropower, but also the role that, the partnerships that we need to develop with our local communities and First Nations in the areas in which we operate. We take put a very high focus on developing open and transparent relationships with those groups. We think Quebec is the new frontier in terms of lithium supply, hard rock lithium supply, and there's a number of reasons for this. Being so closely located to the United States, the key battery and EV markets in the US, we can deliver lithium products into the US on a far lower cost per tonne basis than other jurisdictions around the world. I mentioned Quebec's hydro, which gives us clean and cheap hydropower to run our manufacturing facilities in Quebec. And we think that's a significant competitive advantage relative to other jurisdictions. Quebec is a mining province, over 100 years of gold mining history in Quebec. There's a very high quality resource base, a deep pool of talented labour and well-established logistics networks from road, rail and port infrastructure. And finally, government support. The government of Quebec is highly supportive of mining. They have a provincial strategy to build out a battery metals value chain within the province and to become a leading supplier of critical minerals into the US market. So you add all of those things together and we think that Quebec is very well placed to be a leading supplier of critical minerals to the US as part of the electrification transition. Zooming in on our hubs in Quebec, we run a two-hub strategy, hub and spoke models. In the south, we have a hub called the Abitibi Hub. There's 4 projects in that hub, cornerstone by North American Lithium, which is in production today and under ramp. It's backed by a resource base in the south of 75 million tonnes at 1.18%. We have a target to get NAL to an annual rate of 226,000 tonnes per annum. We think we'll get there by October. And ultimately, NAL's destiny is to go downstream. When we purchased North American Lithium 2 years ago with our partners Piedmont Lithium for $100 million, there's a partially constructed lithium refinery already on site. So again, low cost, fast way to producing downstream lithium chemicals in Quebec for the US or North America. Our hub in the north, this is our exciting growth project Mobilan, which we've just released an upgraded resource. Mobilan is now one of the largest single deposits of hard rock lithium in North America. It's a resource of 51 million tonnes at 1.31% and will get bigger. We're undertaking a drill program at the moment, a 60,000 metre drill program, and we anticipate that could get bigger by the end of the year. Ultimately, the ambition for Mobilan is to produce 100,000 tonnes of lithium hydroxide by 2030, so multiples bigger than NAL in terms of production and future cash flows. NAL, we released a DFS 3 weeks ago, which sets a baseline in terms of operating parameters for NAL. This is a project that we purchased 2 years ago for $100 million, and the DFS came out on a pre-tax basis of over $2 billion. So significant value has been delivered to shareholders. It's a 20-year life of mine, a run rate of 226,000 tonnes per annum, recoveries in excess of 70%. We're dialing down the grade in terms of concentrate production to 5.4% to really focus on getting those recoveries above 70% and to drive out maximum tonnes. Cash costs of around $620 US per tonne on an integrated basis with Ortier. On a standalone basis, NAL will operate around $400 US a tonne. So significant margins and potential cash flows to the NAL joint venture as we progress to the second half of this year. As I mentioned, North American Lithium is in production, and for us the opportunity was really about a low-cost, fast path to production. So for $200 million and under 2 years from acquisition, NAL is back into production. We had over 3,500 tonnes produced in March. To the end of April, we're still ahead of budget, and the ramp's going very, very well. This will ultimately translate into shipments beginning in July of this year. We're targeting 4 30,000 tonne shipments between July and December. Each shipment will be shared between NAL's various customers, which I'll talk about in a second. And our production target for NAL for the period from July to December is a production of between 85,000 and 115,000 tonnes of concentrate for that 6-month period. So NAL's channels to market has 2 main channels to market. Piedmont Lithium, who are a shareholder in the joint venture, are also a customer of NAL. They will receive 50% of NAL's output, or 113,000 tonnes per calendar year, whichever is greater. That commences on the 1st of July. And I think more importantly, each shipment that NAL sends out commencing in July of this year, there'll be an allocation for both the Piedmont offtake and other customers. So we'll have revenue from Piedmont at a fixed price of $900 per tonne, and the other 50% of each shipment will go at market prices for an offtake agreement, which we'll announce to the market soon. So again, highlighting that NAL, aggressive ramp up and very close to generating strong cash flows. NALs, or the Abitibi Hub, also has a strong growth profile. As I mentioned, we have a 50,000 metre drill campaign, which we are commencing shortly. And there's two parts to that. The first part is about converting our inferred resources back into indicated, which we know that the lithium is still there. We just need to get through some drilling to convert those resources back into the pit shell. And the second part is about growing the resource base around the NAL concentrator. We're exploring to the northwest and to the southeast, and also to our neighbouring property, the Valley Lithium Project, which we're earning into a 51% interest over the next year or two. And ultimately that's about providing NAL with a greater resource base, more tonnes at a higher grade for more production as we move forward. We have a feasibility study for the lithium refinery, the lithium carbonate plant on site, and that's currently going through management and board reviews, and that'll be released to the market shortly. Ultimately, with the lithium carbonate plant, we're targeting to have that online by the end of 2026, which would be an opportunity for NAL to be the first and only fully integrated lithium production facility in North America. Turning to Moblan. So Moblan is the growth engine for Sayona. We recently released a resource upgrade for Moblan 3 weeks ago. It now sits at a resource of 51 million tonnes at 1.31%. So very large, very high grade, and is one of the largest single deposits, hard rock deposits in North America. Moblan consists of 4 main pegmatite zones of multiple stacked pegmatites, dipping at about 10 degrees. And I think one of the really exciting things for us is we have a brand newly discovered area, the South Pegmatite Zone, which comprises 50% of the resource that we've just established. That was discovered last year, and with the mineralisation open for the deposit in all directions, provides significant opportunity for us to continue to explore and potentially grow that resource base. The strike of Moblan is over 2.5 kilometres long, the width is 900 metres wide, and it goes down to a depth of 350 metres. So very exciting, as I mentioned, open in all directions, and we're drilling aggressively at the moment to further grow that resource base. We have a 60,000 metre program underway. We're about 20% of the way through that to the end of March. And we're very excited about the opportunity on where Moblan could get to with potential future resource upgrades by the end of this year. We also have a large regional exploration opportunity in the Northern Hub. So Moblan is the little blue dot in the centre of your screen. That's where all of our efforts have been focused on at the present. But there's the potential that the mineralisation from the Moblan property extends eastward into the red zones, which are some claims that we acquired from Troilus Gold late last year. So there's over 1,000 square kilometres of unexplored ground there for lithium, which provides us with a great regional opportunity to further grow the resource base in the Northern Hub to underpin our ambition of ultimately producing 100,000 tonnes of lithium hydroxide from that hub by 2030. Timeline for Moblan. So we've completed the resource upgrade 3 weeks ago. Aggressive drill program underway, looking to another resource upgrade as we get closer to the end of the year. We've got feasibility studies underway for the construction of mine and concentrator for Moblan. That'll be coming out to the market shortly. And then we're looking for first production of spodumene concentrate from Moblan by June of 2027, so only 4 years away. So again, moving with speed to bring tonnes to market to fill the supply gap of critical minerals in North America. So what does this mean? Well, Sayona has the largest hard rock lithium resource base in North America. We are the only producer of lithium in North America, and we're very well placed to continue to grow our asset base in the province of Quebec. We have a resource of over 120 million tonnes at our 2 hubs, with 110,000 metres of drilling underway across both hubs this year. So those resource bases are likely to get bigger. And on a production sense, NAL's ramp up is underway, targeting near-term cash flow generation in the second half of this year, and that annual operating rate of 226,000 tonnes per annum. So what does this mean for investors? Well, there's lots of news flow still to come in 2023. We've already delivered 3 big pieces of news flow with the NAL restart in March, the NAL DFS showing an NPV of $2 billion for an investment that we bought for $100 million, and a resource upgrade for Moblan, which now sits as one of the single largest deposits in North America. We have additional offtake agreements for NAL, which will be coming to the market soon. We look forward to the first shipment and, more importantly, first revenue and cash flow for NAL in July of this year. We then go downstream with the NAL carbonate plant. We have feasibility studies which will be coming to the market soon on that, which again we would anticipate capturing the higher economics of value-add refining on-site at NAL, which are a much higher NPV. We then swing north to Moblan. We've got the drill program underway, looking forward to a further resource upgrade closer to the end of the year. And we've got feasibility studies underway for the development of mine and concentrator at Moblan. So all in all, lots of news flow still to come, and it's going to be a very exciting journey for Sayona in 2023. Thank you very much.
Thank you, Dougal. Well done. Tim, if you want to come in and find, so there are seats just down the front here, you're more than welcome to come on down. No one is going to think, we'd hate for you to actually be standing up the back there. That would be worse. The boys down here have got a seat either side of them. They'd be happy to have your company. Greg down here's got a seat next to him. He'd be happy to meet some new friends. There you go. Right. So next up, Black Cat Syndicate. They're a fast emerging high-grade West Australian gold producer, and they're targeting their first production in 2024, which isn't that far away now. They listed on the ASX in 2018. They've got a really strong record of resource growth. They now control 3 advanced mineral assets with a combined mineral resource, which includes 2 of the highest grade gold deposits in Australia. That's a pretty impressive claim to be able to make, Gareth Solly. I'm going to tell us all about it now. Would you please make welcome the Managing Director of Black Cat, Mr. Gareth Solly.
Thank you, Chrissy, and good afternoon, ladies and gentlemen. It's a pleasure to be back here at Sydney and able to give another update. So we have put out another resource update. We kind of do that regularly, this time for Paulsens again, second update in 3 months, because we've been very active there with the drill. So I'll go through that and talk a bit about what's next for Black Cat. As Chrissy said, we have 2 of the highest grade gold mines in Australia. That's Coyote and Paulsens. We have been very active at both of those. We picked those up June last year, so not long. We haven't owned them for 12 months yet. Been very active on that front. Combined, our resource base is now 2.4 million ounces of gold across all 3 projects. We do have installed infrastructure at Paulsens and Coyote, so for that for us means there's lower risk, lower time frame to getting into production, and lower capital costs to do so. We do have a clear strategy, so we do want to get into production, and we're targeting Paulsens as our first opportunity, and we're working on studies that will lead to a decision in the middle of this year on doing that. Bit on the corporate structure, 267 million shares on market, about 130 million market cap at the moment. Top holders have about 46% of the stock. We've got a few big funds in there, Franklin Templeton, US Global, Earth Resources, and then our directors are very large holders as well. Those directors include Paul Chapman and Les Davis. So, Silver Lake fame, they took that from a concept and built a successful gold mining business. Certainly we want to do that again. We've got Tony Polglaze, who's built mills all around the world and took Avanco from exploration, development, production and takeover. And we've got Philip Crutchfield, who's a King's Counsel here on the East Coast, and he is also on the board of several other junior explorers. I'm a mining geologist by background, registered manager at Daisy Milano for a few years back in the early days, and certainly looking forward to taking this company into production. So we've been around 5 years now, and the one thing that we've always done is put the shareholder money back into the ground. We've been trying to build our resource base. That's how you can measure how successful a junior resources company is. And we've done that very successfully through a combination of acquisition and discovery. So 2.4 million ounces, and now we're focused on taking it to the next step, getting it to production, focusing on the high margins that come with high grade deposits, and then we'll put those funds and the cash flow back into the business, because we have 3 projects. We don't need to go and purchase a second one. We can just start the second one once we've established our first and we have sufficient cash flow. Should that get into production, we've got production targets set. and we could be a sort of 150,000 ounce producer once all of them are up and running. So I'm going to talk to Paulsens, Coyote and Cal East, more concentrated on Paulsens this discussion. That's where we've been most active. There's lots of numbers coming out of that, and we have just released a new resource today, 322,000 ounces at 10.1 grams per tonne. So that's a 25% uplift from the last one, which was 3 months ago. So we've been very busy there. We've got restart studies underway, and we'll make a decision middle of this year as to what we're doing, taking that project into production. Coyote, another very, very high-grade resource in the Tanami. There's lots of activity going on there, but for the moment we are very much focused on Paulsens as a primary goal. And Cal East, we've got a big resource sitting there. We released a PFS last year, and certainly that is ready for when the conditions are right to go and build a plant outside of Kalgoorlie. So Paulsens is the asset that there's a lot of people who know it because it started Northern Star on a trajectory from an explorer. It was their first mining hub and gave them the cash flow to go and pick up the Barrick assets when they exited the country, and the rest is history. They've gone from strength to strength, but this is where it started. So for us, we've got 1,000 square kilometres of very prospective ground where we really like the exploration potential here. But we also have the infrastructure. We've got 450,000 tonne per annum plant. It's been kept in care and maintenance. We've got a dewatered, ventilated, powered underground. So we've got drill rigs that are in the underground at the moment drilling. So able to rapidly grow the resources based on drilling around the underground. We'll talk about the resource next. So 322,000 ounces is the new number. There's an image there of sort of where it sits, so some remnant, and a lot of it is new. There's 133,000 ounces in the Gabbro veins. So that's a new target for us and a new target for Paulsens. But this is a high-grade resource. We've been very focused in the last few months about infill drilling to try and convert more inferred into indicated so that we could get it into a mine plan so that we can then make a decision about restarting this business. But since we acquired this project, that underground resource has grown 360%. So Northern Star left us a resource, they left a small reserve on their books, and we've been able to grow that resource, and we'll be working on a reserve next. As I said, the resources come from growth in the existing resource as well as new resource in the form of the Gabbro veins, which I'll talk to in a minute. It is open. The other thing to note here is the chart down the bottom shows over the 12 to 13 years that this operation ran with a couple of different companies owning it. It had anywhere between 500,000 and 100,000 ounces per in resource. It only ever really had sort of a 2 or 3 year mine life in front of it, which is very typical for WA underground gold mines. We've taken it now to 322,000, so we're well above the average, and obviously we're still drilling, so we do expect to continue to grow this resource. So what's next for us? As I said, we're looking at putting out a study. It'll be effectively a feasibility type level study. We're calling it a restart study because we've got all the infrastructure there, we've got all the approvals. It's a matter about working out the cost of the refurbishment of the mill and about working out the mine plan, and that's what we're working on at the moment. We're planning to complete that work over the next sort of 2 months, so we should have the study out and then we'll make a decision on the back of that. At the moment, we have a very experienced team on site. We've got a new general manager there, so he's taking a lot of the bits and pieces back out of care and maintenance and into production. And we're fielding lots of calls from people that have worked at Paulsens before that are inquiring about going back there, when are we going to get it going, which is very encouraging. We feel it's a small mine, we should be able to man this up and get it going, even though the labour market's not still great. We've got engineering in-house, we've got geology in-house, and we're still drilling, so we're continuing to grow. The Gabbro veins is something that has been a success story for us. So Paulsens itself sits on a break in the Gabbro. That's where the bulk of the mining, the bulk of the gold was always known to exist. For us, we've been drilling all these high grades that sit in the Gabbro, so narrower vein, but certainly very high grade. Currently 133,000 ounces sitting in there in this current resource, so 41% of the resource, and it's a new area for the mine. It's a new area that could potentially come into production soon. We're also looking at the bigger picture. So here we've got the mine Gabbro up top. There's 1.2 million ounces that have either been produced or still in resource there. And then below there's an interpreted Gabbro position evident in the geophysics, and that's a target for us. So we're going to be drilling that over the coming months and also doing some EM to help us refine targets. And who knows, 1.2 million ounces in the mine Gabbro, who knows how much is in the lower Gabbro. There's also offset targets. Where does the mineralisation go at the base of the mine after the post-mineralisation fault? So we'll be doing that work to go in and target on those areas, and potentially they're transformational, discovery opportunities for this mine. There's a lot going on in the area. I said before, we really like the exploration potential here. For us, we're sitting on a regional fault, the Nanjil-Gardi fault, and anywhere along that fault, splays could form multi-million ounce deposits, and that's evident in Paulsons, in Mount Olympus, in Karlawinda, all along that fault line. We've got lots of base metal, copper anomalies. We've got gold anomalies, silver anomalies, all that need further follow-up. So most of this is rock chip and soil anomalism, and there's not very much drilling. There are a few other resources that we'll be targeting to extend and grow within the portfolio. So two of those that we'll be targeting early on will be Belvedere, which is 5 kilometres from the mill. No drilling has really been occurring in this area for probably the last decade, but there is some good numbers there. It's at one end of a sort of a 2 to 2.5 kilometre long fault with mine workings and rock chips all along that. So really prospective. It needs more work. We've already wrapped some very high level mine designs around that. So we think it could be a satellite deposit to be worked into the mill in time. Mount Clement is a fantastic deposit. The geos love this one. Polymetallic, it's got a bunch of different minerals and obviously lots of payable minerals in this. Currently the third largest and second highest grade antimony deposit in Australia. It sticks out of the ground, so it hasn't been too hard to find so far, but that's where it sticks out of the ground, is where it's been, mapped, sampled and drilled, and then there's lots of opportunity where it goes undercover. So it's open, it's a large resource, it's a very attractive resource in terms of the different commodities that are within that, and we'll be doing work here in the second half of this year to continue to grow and explore. Over to Coyote, we'll go to the up into the Tanami. A lot more remote, obviously, but we still have plant here. We've got in fact the only infrastructure in sort of the Western Tanami, which is a belt that stretches obviously from the Northern Territory through to the WA. We are all in WA here, so we go right up to the border. We've got a fantastic land holding, 885 square kilometres. We've got a 300,000 tonne per annum plant. It's been in care and maintenance since 2013. And there really hasn't been a lot of exploration occurring up in this part of the world for a couple of decades, really. We like this. We did 5 months of drilling here last year, all focused in on the Coyote Central resource, really nailing in on that underground area. And we've got a 356,000 ounce resource in that underground at 14.6 grams per tonne, so it's very high grade. This is what it looks like in a long section. The grey on this image is the workings. They did a shallow open pit and then a small mine. There was about 211,000 ounces came out of this area before it finished in 2013. Very much the mining all focused on the southern limb of an anticlinal structure, and that anticline is where we've focused. Back into the core of that anticline is where we've been drilling, because if you look at the larger deposits in the Northern Territory, the greatest endowment of the gold is in the middle of that anticline. So we just use that knowledge and target in on that, and we've had substantial resource growth in the first drilling that's happened here for a long time. So there's an open pit, there'll be an underground, and we'll do that work in time. At the moment, we'll be out doing some regional work over the next few months while we can with the seasonal windows. We have large gold, arsenic and bismuth anomalies, and they're things that we'll be chasing, looking for, again, multi-million ounce deposits, similar to Cali down the road. Cal East, here we listed with 80 square kilometres, no resource. We've now got 1,000 square kilometres, 1.3 million ounces. We released a feasibility study last year, which shows good cash flow after building an 800,000 tonne per annum mill, and that mill goes onto an approved site just outside of Kalgoorlie. Clearly, with the current gold price, there'd be a lot more cash flow in that. We just released the resource update. As I said, we're now working on the mine restart study, and that'll lead to a decision to mine middle of this year. Should that be a positive decision, we'll start the refurb work early in the second half of this year, and that could lead to pouring gold early 2024. So just to recap, very high grade, very fast growing, lots of established infrastructure to de-risk the project and get us to production and cash flow early. We are currently targeting a decision in the middle of this year, which could have gold being poured early next year. It's a great time to be in gold. We're really looking forward to getting this into production as soon as we can, and we've got an experienced team and really good projects to work with. Thank you very much.
Thank you, Mr. Solly. Fenix Resources. Hello, hello. If I was an investor, I'd like the look of you coming up here, because I read one of your statements recently which said payments to shareholders is a big part of our plan is a big part of our upcoming plans. Sounds good. Is anyone who's invested in this company? Oh, a couple of you. Did you like that statement? Yes, now we just have to wait to see how big that may or may not be. Fenix Resources, high-grade, high-margin iron ore producer located in the prolific Midwest region of Western Australia. Their company's flagship Iron Ridge Iron Ore project is a premium DSO deposit that hosts some of the highest grade iron ore in Western Australia. And this fellow here to tell us more about it is their chairman. In fact, he's in charge of many things, but I reckon this is one of the ones he's most proud of. Would you please make welcome John Welborn?
Thanks a lot, Chrissy, and well done. You do a great job. Right, shut the doors. As Chrissy's just said, I'm going to make you some money. Fenix, unusually, is a highly profitable iron ore miner in WA's Midwest. It's great to be here in Sydney. Last time I spoke at one of these conferences was in Busselton, another hiving metropolis and centre of world activity and finance. But it's fantastic to be here in Sydney. I first came across here as a very young Western Australian rugby player and played down at East and ended up playing many years for the Waratahs and occasionally when they picked me for the Wallabies in an era where, as I point out to people, we used to win. So it's great to be back here in Sydney representing the WA iron ore industry on a day when almost single-handedly as a Western Australian iron ore miner we've dragged the Australian economy into surplus. Fenix is a small-scale miner and we do pay a fully franked dividend, which I think is what Chrissy is referring to, and I'll talk a little bit about that story. We're not a lithium producer or a lithium hopeful, we're not in the gold market. But in amongst those hilarious jokes about rugby and WA iron ore mining, no one should be, it shouldn't be lost on people that the richest people in this country are iron ore miners. And I'm sure there's a space for all of us to get into it. And I'd encourage you to be a shareholder of Fenix. I've got a little video here. This presentation is available on our ASX platform. And I'll talk through this video because let's go and have a look at our operations. There's a fantastic ore body. Look at it straight down the centre there. This is the Iron Ridge mine. It's in the Midwest of Western Australia. We mine and haul to Geraldton, which is 400 kilometres north of Perth. Very simple drill and blast operation and truck. It's effectively a quarry. We're currently mining at 1.3 million tonnes a year. Simple crushing and screening plant produces a 64% clean lump product. There you can see it, and a 63% fines. That's the weighbridge at Iron Ridge loading into our fully owned haulage fleet. 200-tonne trucks. There's our only side tipping loadout in Geraldton Port that we own. And that loads into a fully Fenix-owned shed at Geraldton Port. We have an Indigenous operated business that looks after our port handling. and that allows us to load Panamax boats. We have 100% offtake with 2 offtake partners, Sino Steel and Atlas, and so our iron ore then travels to China and also to global customers a lot in Southeast Asia on shorter shipping routes. So it's a unique business. Even though we're a small-scale iron ore mine, we own and operate our mine, we own and operate our haulage logistics train, and we own and operate our own port facilities. So in summary, I mentioned we've got a fantastic product, a unique ore body of microplate hematite, low impurities, and outperforming our expectations in terms of its ability to deliver lump. The original feasibility study for Fenix was to produce 1.3 million tonnes per annum, and that's exactly what we're doing, almost exactly as anticipated. A very rare example of a exploration, development and feasibility study that's gone exactly to plan. Last year we acquired the other 50% of the haulage joint venture we set up as part of that development plan, and so we now own 30 truck and trailer combinations that haul all of our ore, and we've been able to generate strong cash flows and pay dividends to shareholders as mentioned. A little bit about that pathway. Fenix raised $15 million from shareholders in 2019 and 2020. We started the mine in late 2020. First production was put into the boat in February of 2021, and we recently departed our 50th cargo from Geraldton, and at the end of June of this year, if we're on track, we'll produce our 3 millionth tonne of iron ore. And I'm very proud to say that having raised $15 million from the market, we've paid back $53.5 million in fully franked dividends. We've got more than $70 million in the bank, and we're making money every day, particularly at current strong iron ore prices. There's the Midwest, Geraldton, 500 kilometres of haul road between Iron Ridge and the port of Geraldton. And you know, I know there's a lot of young investors that have come to this conference, but the older investors, if there are a few here, will remember many companies that have explored and successfully discovered iron ore in WA's Midwest. Almost exclusively the big iron ore producers are out of Port Hedland in the Pilbara and in the north of Western Australia. For 30 years, a range of hopefuls have spoken about the potential of the Midwest to expand and be a significant iron ore producer. Mount Gibson were doing 6 million tonnes out of the existing port of Geraldton for a period of time from Talleyrand Peak and Extension Hill. Companies like Murchison Metals, Jindalby, Flinders Mines, the Midwest Iron Ore Alliance, the Geraldton Iron Ore Alliance, all were promoting the opportunity to do 10, 20, 30, 40, 50 million tonnes a year from this region. That potential still exists. We are really excited at Fenix about the integrated logistics platform that we've developed. We are mining a very efficient ore body, but quite a small ore body at Iron Ridge. Our latest resource statement was 8.3 million tonnes at just under 65% iron ore. So we've got 5 years of mine life in front of us at the current run rate of 1.3. But we're obviously interested in growth. We're interested in finding, discovering and acquiring more iron ore in this prolific Midwest region to extend our mine life and to exploit the other obvious opportunity of increasing our production rate. But first of all, let's look at and describe a little bit about our existing operation. There's a nice picture of Iron Ridge. It's a really clean and nice mine. One digger, 4 trucks, run by Chris Tuckwell. He's the former managing director of Macca Mining, and Macca Mining are a mining contractor on site, and they're doing a great job since inception. There's our 2 product stockpiles from our very simple crushing and screening plant, also operated by Macca. And you can see in the foreground there is our 64% lump product, and the other cone is our 63% fines product. We were originally expecting around 40% lump, and we're actually outperforming that, and very strong blend with very few impurities. And we get a slight premium above the 62% index price, which is pleasing. Very well controlled mine, very simple operation. We mine, crush and screen, and then directly load our haul trucks. As you can see, our haul truck's a specialty designed trailer combination. It's a quad 65 metres long. We've had that constructed in Western Australia and licensed on the relevant roads. It's a state-of-the-art business that is a huge cost advantage to Fenix. 93% of that 500 kilometre haul road, the drivers are on full cruise control. We have retinal scans on our drivers. Every single truck is the same, and we're getting best performance in terms of kilometres and fuel efficiency across the industry. We're setting new standards and leading the industry in bulk haulage. Another significant advantage of Fenix is we own and are the only side tipping loadout station at Geraldton Port. It's a Fenix asset. You can see one of our quads being unloaded there, and that conveyor leads directly to a Fenix-owned shed where we store our iron ore and stockpile for our regular Panamax shipments. And here's a Panamax boat being loaded at the port of Geraldton. Let's talk about growth and what's next for Fenix. The Iron Ridge mine does have extension capabilities. Fenix has acquired 100% of the iron ore rights of the Pharos project that surrounds us. There's a number of opportunities we're exploring there. And I mentioned also the many other iron ore deposits that are currently stranded, not being mined, that exist within the Midwest. If you draw a 600 kilometre circle around Geraldton, you capture billions of tonnes of iron ore that has been explored and defined, and a lot of that is available for extraction. And we have an infrastructure corridor that is movable and relocatable, and we're actively continuing those discussions and very ambitiously pursuing a growth concept. Our ability to fund growth is obviously supported by a very strong operation and balance sheet currently. And that is supported and has been proven to be a strength of Fenix is our hedging policy. We put in place swap contracts for just under half of our production. So we currently have 50,000 tonnes a month hedged at 175 Australian dollars to June. And then from July to December, we have 40,000 tonnes a month hedged at a similar price. And that smooths out what has been a very volatile journey in iron ore. Recently the iron ore price was $120 a week ago. It was 103. Today it's 110. But effectively we've got a strong margin locked in on that hedging component, and that is one of the many things that's allowed us to fund and pay a strong dividend to our shareholders. We also have a strong focus on technology. We recently launched a driver training simulator, which is the first of its kind in the world. It's something that's more commonly deployed in the airline industry. That is $1 million investment in a driver training module that effectively completely replicates the 500 kilometre haul road from Iron Ridge to Geraldton and back, and it allows us to take young Indigenous and other trainees and put them behind the wheel of what is otherwise a 200-tonne, 100-kilometre-an-hour bullet in a safe environment in the same way that the airline industry does, and take them on a journey to be a future Fenix employee. And that's part of a commitment that we have to the traditional owners of the land on which we operate and mine, the Wurundjeri Yamaji people. We have an agreement with them that is fundamental to the formation of our company. And I'm proud that we have one of the highest Indigenous employment rates in the Australian mining industry, and something that we continue to work on is our partnership with the traditional owners. And that includes not only direct employment, but also sponsoring the creation of Indigenous-owned businesses. So I mentioned when we did the quick video scan that our port loading is actually a joint venture business that we set up with an Indigenous group, and that's an example of our sponsorship and support, not only for direct employment, but also for the creation of ongoing sustainable business for the traditional owners. We're very keen on our position in the Midwest. We're one of the largest employers, having created 200 jobs in and around Geraldton, and we're looking to create more with greater growth. What that looks like, Geraldton Port has done up to 10 million tonnes a year. The state government in their last budget announced a $350 million investment in the existing port. Often the iron ore potential of the Midwest has been linked with the potential creation of a new bulk mineral port just north of Geraldton at a place called Oakajee. Fenix, we have an existing position at the existing port. It's being expanded. We think that that there is available capacity there for Fenix to do up to 5 million tonnes and possibly 10 million tonnes. We have to find that material, but we have the capacity both in terms of our existing port operations and our existing haulage operations to quickly and easily expand those. Based on the success of our mining operations at Iron Ridge, we're looking around for more material, both at Iron Ridge, nearby within the World Range, and in that larger circle of the Midwest, capitalising on the potential that's been there for many years. I've got a minute till Chrissy stands up and then possibly boots me off the stage. So let me summarise here on Fenix. One of the things that will jump out to the investors in the room is that dividend yield of 20%. I mentioned, the cash flow generation we've had in the 2 years we've been operating. Both of those years we've paid a 5.25, 5.25 cent fully franked dividend. We're on track for another very profitable year. Our dividend policy currently says that we will pay 50 to 80% of our net profit after tax to shareholders as a fully franked dividend. We believe it's possible to continue to pay a generous dividend while we fund growth, and that's consistent with our model. We're looking for low capital, very high return businesses. We believe there's an opportunity to build a large-scale, sustainable business in the current iron ore price environment. We think that there's an opportunity for growth that will not only drive greater revenues, but also allow us to bring our costs down. One thing not mentioned in this presentation, and people may be interested, is our cost structures. The last 2 quarters we've averaged a FOB cost of around 80 Australian dollars, just under 60 US. That's a fantastic job when you're producing 1.3 million tonnes per annum of iron ore. It's a business that rewards scale, and we think there's a journey for Fenix to be a much lower cost, higher volume producer of iron ore. The best way to bring your cost down in bulk commodities is change the denominator, spread your fixed costs over more tonnes, and that's a key part of our journey. We've got a very small team. I'm joined here at the conference with Stuart Osmeyer, who's our Chief Financial Officer. We're at booth 74. We've got lots of pictures to show you, and I'm very interested. Come and have a talk about Fenix, profitable iron ore producer and ready for growth. Thanks, Chrissy.
I've never taken on a lock before, but I was just wondering what position I should be in to try and boot you off the stage at 192. Yeah, I should, I should have mentioned perhaps that you were mildly talented at rugby. I probably also should have mentioned that you're a great philanthropist, and something you should know about this fellow. He's a really great philanthropist, and when he says he's going to do something, he does it. And I would believe that carries on to everything that he does in life too. So go and have a chat with him and find out what... Oh, look, the doors have unlocked at the back suddenly. There we go. All right. We're going to go into the world of uranium now, and this is our first foray into uranium at RIU 2023. It comes courtesy of Aurora Energy Metals. Now, the fortunes of uranium on the way up after what can, I think, best be described as a gentle decline about 18 months ago, and if you looked at any reports by McKinsey around that time, they were pretty agnostic about nuclear power, and that pretty much changed. 2 weeks ago, they released their latest report, didn't they? Would have been 2 weeks ago, Greg?
Yep, that's
yeah,
right.
so they released a report. I'll let you go into all the details. This is Greg Cochran, everyone. He is the MD of Aurora Energy Metals, and they have an advanced stage uranium explorer and developer. Would you please make him welcome?
Thanks for that introduction, Chrissy, and good afternoon, everybody. It's a pleasure to be here again to be talking on a slightly different subject, obviously uranium. I noticed that the final session of the day is called the Power Session, but I think I'm going to claim that title for just my presentation. After all, those of us that are aspiring Tesla drivers and EV drivers, etc., won't have much power without nuclear power. Safe, clean, reliable, affordable, sustainable nuclear power to power and charge those wonderful lithium-ion batteries for your EVs. That's why this is an important story, and I'm just love telling it as well. A really passionate story. Of course, draw your attention to the usual disclaimer. There are forward-looking statements, but that's par for the course, and you won't have to sit a quiz when I'm finished. Just in terms of the team, before I get into the detail of the actual project itself, in the USA, it's a small team. We listed almost exactly a year ago. We were an unlisted public company, so that comes with its own challenges, of which I'll remark on a little bit later. But a very experienced small core team with a lot of experience, both corporately in uranium, funny enough, in lithium, and also in the USA. So a good cross-pollination of skills that can add value to this wonderful project that we have. Of course, the company itself, when you assess your investment opportunities, you've got to figure out in the minerals industry what are the key drivers to making that investment decision. And you always start with a fundamental asset. You don't just say, oh, I'm going to invest in the USA or in Australia. You say, okay, what's the commodity? What are the attractive assets within that geography? And then you look at the team that can deliver on particular promises, whether it's a wonderful operating entity like Fenix, or whether it's an exploration play. And then finally, you look at the jurisdiction and you say, okay, well, it's Cameroon or the Congo or Namibia or the USA, and you make your decision based on that. And the USA is a great place to be doing business in all critical minerals, of which, although by definition in the USA, uranium drops out of that definition because it is by definition in the USA, all energy minerals are critical minerals. So it's a curious thing, but the industry, by the way, is fighting that definition because they feel that we're missing out on some of the opportunities, the wonderful tailwinds that are pushing the industry forward. Nuclear, after all, in the USA is 20-odd% of their electricity generation, but well in excess of 50% of their clean energy generation. Not only that, that means that they've got this well-established 50-year history, both in uranium and in nuclear, well-regulated, well understood. And whilst, as Chrissy said with her research beforehand, that there had been decline over the years, and the McKinsey study, 2 in the last 3 years, indicated somewhat agnostic kind of like, yeah, maybe steady state decline. 2 months ago, all of a sudden, they've had this epiphany where they are forecasting a doubling of capacity nuclear energy generation in the US, not entirely driven by the small modular reactors, but also by the big reactors such as Vogtle 3 and Vogtle 4. Vogtle 3 was turned on just a few months ago. Vogtle 4 will be commissioned also in the coming months. So that's the first of the latest generation of large nuclear power stations to be turned on in the US, the first in decades. So that's wonderful news for us. And on the other hand, they're desperate for domestic supply. When this asset was part of a company called Neometals in the early 2000s, in that era uranium boom, my former company Uranium One acquired Neometals for $1.6 billion in June 2007. Gives you a sense, obviously it wasn't just the asset that we own, but it gives you a sense of the volatility and the value in good uranium assets in a good jurisdiction. A couple of quotes there that are really important. The one speaks to the physicist, that's the Assistant Secretary of the DOE, and the other one is actually a quote from the McKinsey study that not only looks at doubling of capacity in the US, but also 400 to 800 gigawatts globally, which is absolutely massive. And I've not seen those numbers until I saw this McKinsey report. So where are we at? The interesting thing about this deposit is it's well defined, and that's critical. We're not early stage explorers. We're an advanced stage explorer with a well-defined deposit that was discovered and drilled out in the 70s with enormous amount of test work. It is the largest mineable, measured and indicated uranium deposit in the US, and I'll back that up with the next slide. The critical part about it, though, is it's this core high grade, which is only 20 million tons, giving us 20 million pounds in round figures, which is almost 100% measured and indicated. So no geological risk to speak of. Well understood geologically. And the next step is the metallurgical test work. We tapped into historical work, and we're close to doing the next step of that work as well. It's also in a historic mining area, and we're the closest to the infrastructure that was developed in that old mining era. So we've got hydroelectricity from Oregon coming in to a substation on the location where we'll build our plant, sealed roads, and a local community that is well adapted to and understands mining, and makes my job easier in telling the story and engaging with First Nations people and just with the local community as well. I mentioned we listed almost exactly a year ago, probably at the tail end of what had been the booming uranium industry, and all the markets have off since then, and uranium has suffered perhaps more so than most, which is counterintuitive given the excitement and the potential of the uranium industry and how it's changed in those 12 months. That being said, of course, the listing meant that, having been a public unlisted entity, I inherited 1,200 shareholders who had not been able to trade for 10 years. And so I created this liquidity event, and so we've been wearing a bit of that. But we've achieved a lot in that 12 months of listing. And in fact, if you go back to our prospectus and you have a look at what we set out to do, we've ticked those boxes. The most important one being that large resource upgrade, critically permitted and did our first drilling program, so we generated core for our metallurgical test work. We've completed this review of all the historical test work, and we're ready to do the next phase of that. But importantly, we unlocked the pathway to development, and I use that term advisedly, and you'll understand in the coming slides why I say that. Just to back up my claim about the largest mineable measured indicated deposit in uranium deposit in the USA, there are the other comparable conventional, and this is a conventional open pit operation. The largest one by far, of course, Coles Hill, is in Virginia. Virginia has had a 40-year moratorium on uranium mining. And this is not a WA or a Queensland whimsical political decision where tomorrow's change of government precipitates your ability to go ahead and mine uranium. This is an entrenched moratorium. They have no regulatory regime to monitor and permit uranium mines. So Coles Hill is dead for many, many years to come, which puts us in the pole position in a country that's desperately seeking domestic supply. I briefly mentioned that pathway to development, and this is a key aspect. So Oregon, where we're based, Southeast Oregon, which is desperate for investment and upliftment and job opportunities, but it is not a mining state, and I'd be the first person to acknowledge that. However, we're right next door to Nevada, which is a fantastic, well-known, well-understood mining jurisdiction. And in the lead up to the IPO, we were already saying we are going to seek ground, land in Nevada because we're so close to the border, and we're going to build our plant in Nevada. We've actually exceeded those expectations by going one step further. Fortunately, I was with a colleague now retired who had worked there with a predecessor company and had great community networks and relationships. And they reached out to him when we were there, and they said, I've got one of the farmers, I've got a 410-acre property that I want to sell. Are you interested? And we snapped it up. So that wasn't in our budget, but it made total sense. It's on the Nevada border, substation on the northeastern corner of that property, fed by 6.5 US cents per kilowatt hour hydroelectricity from Oregon. Unbeatable almost in terms of your energy equation. Long-term, reliable, cost-effective, and importantly, clean. Bit of the conceptual design. Because of Oregon's laws, it's fairly straightforward to permit a hole in the ground, a quarry. Once you start involving chemistry and chemicals and you want to build a plant, it becomes a lot more complicated. That's why we've chosen Nevada to do this two-step process. So you can see this very distinct differentiation between the quarry operation, and an Aussie company has permitted a mineral sands mine there just over 10 years ago. They built the mineral sands mine, and that was in a sensitive part of Oregon. It was on the west coast, so it's a beautiful area. They got it permitted, they built it. Unfortunately, The market turned against them, and so they had to shut up shop, and they were never seen again. But at least it demonstrates that Aussie juniors can permit even in Oregon, and they can build. So this is a plan view of the uranium deposit. I've highlighted two sections. The one in blue, which you can see on my right-hand side of the screen, shows you the nature of the deposit. It's hydrothermally introduced fluids that have altered rhyolites in a basement, and that's where you've got your deposition of the uranium. If you look at a larger section, what's excited about this, from me being the sort of mining engineer from years gone by, is how easy that is to mine. So you start off with low stripping ratios, and you build up over time as you go into what are effectively lake bed sediments. So soft, free dig lake bed sediments, really easy mining, low stripping ratio to start with. It also benefits from physical beneficiation. So you can reject 30% of the low grade stuff, and you feed a much higher grade feed. So from 480 to around 600 ppm, which is a decent grade for this sort of operation, into your plant. So your plant at the back end is smaller, more cost effective, because your reagent consumption is down, your energy consumption is down, and your recoveries, overall uranium recoveries, go up. I'm not the one to then say, oh, well, we're also going to jump on the lithium bandwagon per se, but the reality is that we're in the McDermott caldera that hosts two of the two largest lithium resources in the USA. And we've demonstrated that, yes, our overlying sediments are lithium lake-bearing sediments. This is not the top priority given the advanced stage of our uranium, but this is something to consider as blue sky potential for the company. There's a better long section which shows you exactly the deeper part of the other side of the fault, the Graben area, which was historically drilled, and we've popped the first 2 holes in the modern era in last year's drill program there, and in fact we intersected both lithium and uranium. So there is blue sky potential beyond what we have today, but the uranium resource is big enough to actually drive the value of the project forward. And that's what we intend to do with this work program. Scoping, metallurgical test work, scoping study wrapped up by the end of the year, drilling to then generate the next core for the next phase of metallurgical test work, whilst in parallel doing the permitting. We will try to test the lithium further afield if we have the funds available, but the clear focus is absolutely on delivering the uranium. And therein lies the opportunity. If you look at our relative valuation, we are way undervalued compared to our peers. And given the jurisdiction and the scale of the deposit, we're really well positioned for a wonderful uplift in evaluation, just as the uranium market, the nuclear market turns. And that's what makes us such an attractive investment opportunity. Thanks for your time, thanks for paying attention, and you're welcome to come and see me at booth 63.
Thank you, sir. Very comprehensive, and you can come in for the last session as well and add your thoughts to that. Scotty Williamson, how are you, sir? You're a busy man lately. Coming up, you've played musical chairs there with our last presenter. Scott is a regular here, and there's been lots happening for him over in Vietnam as of late. He was with us in Singapore and was a guest on a number of our panels with some really insightful look into doing business in Southeast Asia. He's here. I was just doing a little bit of research on the side and looking at the balance sheets and where you aim to be, and 2025 is looking like a fantastic year for you guys. If you want to get on now and follow them with the journey, he's going to tell you why, how, and what the upside is to be explored. Will you please welcome Scott Williamson, Managing Director of Blackstone Minerals.
Thanks, Chrissy, and thanks to Vertical Events for the opportunity to present again today. As you can see there, that we've got the previously operating Ban Phuc nickel mine in northern Vietnam. So it was an operating mine between 2013 and 2016, and it went into care and maintenance when the nickel price was $8,000 per tonne. So much lower than today's prices. We're looking to restart the mine, but we're also going to build a downstream refinery which will produce the chemical products required for the lithium-ion battery. So it's a vertically integrated mining and refining strategy, and we'll be using the abundant hydroelectric power that we have in the northern Vietnam region. So we have two of the largest hydropower plants in Southeast Asia, in our Son La province in the northern Vietnam region, and that when the mine previously operated, the cost of power was around 7 cents per kilowatt hour. Since we acquired the asset around 4 years ago, we've drilled over 100,000 metres. We've defined what we see as a globally significant nickel sulphide district, and that's driven by a large-scale resource and reserve, around 500,000 tonnes of nickel in resource, and converting about half of that into mining inventory and reserve. We're also looking at a first quartile cost position, which is driven by that low power cost, but also the competitive labour costs in Vietnam, and with one of the lowest carbon footprint nickel projects in the world, and that's been independently verified by the Nickel Institute. It is a partnership model, so we are looking at downstream partnerships with the lithium-ion battery industry. We've particularly focused on South Korea, and we will bring in partners that will help fund, but also bring some of the technology required to produce those downstream chemical products. Just a quick corporate snapshot. So last quarter we had $16 million of cash. We also have listed investments around $10 million. So we're well funded for the next phase of studies. Board and management team, my background's in mining engineering. Hamish and Frank are geologists. Alison is a corporate governance expert, and Dan Locker is a mining engineer who worked for Western Areas for many years as a managing director, which was one of Australia's most successful nickel mining companies. Very supportive shareholder base with Fidelity, one of the largest institutional investors, Deutsche Balaton out of Germany, so very supportive institutional shareholder base, as well as Nanja Savetta out of Hong Kong. Board and management with a strong position of 5%. Also some great coverage from the sell side. Just recently took a heap of mining analysts out to site, and they've updated their price targets, and they're well above the current share price. So you can see here we're located in the northern Vietnam region. We're looking to build an upstream mine and also a downstream refinery. So the mine will be a large-scale open pit with a number of small underground mines. It'll be a low strip ratio of around 3 to 1. We will be plugging into that hydro power. We've got byproducts as well, so it's a magmatic nickel sulphide. Byproducts of copper, cobalt, and all the full suite of platinum group metals. So the refinery is interesting. It's a downstream hydromet process, and we'll go into more detail, but basically we're going to take the nickel concentrate and convert it into the chemical products required for the lithium-ion battery. So we'll produce nickel and cobalt sulfates, and then we'll combine those, the nickel, cobalt and manganese into a chemical product in the ratio of 8:1:1. So it's a high nickel cathode, and that's an important part of the electric vehicle, particularly if you want long range, you need a high nickel cathode. You can see there we have a number of interests in other junior developers, and the idea there is that those developers one day will produce nickel concentrate or nickel products that we can then feed into our refinery. So the refinery will have 50% of the feed will come from our nickel mine in Vietnam, and 50% will come from third-party feed providers, including groups like Trafigura and other nickel traders. So we're in close discussions with other nickel providers for that 50% of our feed, and that may come from our strategic interests in Lynn Lake and Monago, which is in the Manitoba district of Canada, which is a jurisdiction that we like because of the also 100% hydroelectric power, and also have an interest in Wingelina, which is a large-scale nickel laterite in Western Australia. So we're looking to bring nickel into Vietnam, upgrade it with that low power cost, the low competitive labour costs, upgraded into that NCM 811 product. That trades at a significant premium to the nickel metal price on the LME. And there's a movement towards a higher nickel, even higher nickel content. So 811 is where we see it currently sitting, but there is a movement to even more nickel, maybe a 9.5, 0.5, or even higher nickel chemistries. A big focus from our downstream partners on the ESG credentials of our nickel. So we will have some of the lowest carbon nickel in the industry, and there's a big focus from our downstream partners, particularly lithium-ion battery and OEMs. What we're seeing is that particularly the European brands, those more premium electric vehicle brands, they just can't be tarnished with a bad reputation of taking dirty nickel from somewhere like Indonesia. So it's all driven by the ability to access that renewable power, the electric mining fleet. So we included a full electric mining fleet in our pre-feasibility study. The pressure oxidation flow sheet is a much cleaner and more efficient process than the conventional pyromet technology, which is used for the stainless steel industry. So we've got a blank canvas here, and we're building a refinery that is tailored for the chemical products, and the rest of the industry is really trying to retrofit their tired, dirty infrastructure, which has been set up for the stainless steel industry. So I've got an ability to really tailor it to the requirements of the lithium-ion battery chemical products. A lot of people ask, well, what is it like to operate in Vietnam? I often say, well, it's a shitload better than going to Africa. It's a great jurisdiction. We've been very happy there. A lot of support from the local government. The previous owners really did the right thing, and they paid their taxes. They looked after the local people and the environment. And so when we came in, they knew that as Western operators that we would look after we'll sort of focus on our ESG and really do the right thing by the government. So they've really rolled the red carpet out and said, well, can you just get on with it? And obviously they're waiting for us to complete our studies. But yeah, some very competitive labour costs. You can see there some amazing infrastructure with the power and that hydroelectric power. Some of the best infrastructure we've seen in an emerging market for a long time. So you can see here we will look to sit in the first quartile from a cash cost perspective. So this is the nickel sulfate producers at the moment. We will sit in that lowest quartile for cash costs. You can see a much better cost than our nickel laterite peers, particularly out of Indonesia. And so there we have a nickel sulfide, which drives those low operating costs compared to some of our nickel laterite peers. But more importantly, it'll drive a lower carbon footprint. So we have a roadmap to net zero and particular interest from our downstream partners on how we can move towards these net zero type levels. We're starting to see threshold limits on CO2 for nickel, and that's it puts us in a really strong position because those thresholds that are being mandated won't be able to be achieved, particularly out of Indonesia. So you can see there, the Indonesian RKEF nickel pig iron to matte process has a carbon footprint of 6 times what we're looking to achieve. So positions us very well with respect to our discussions with downstream partners. So this is our district. We started with 25 targets. We've tested probably about half of those. We've got 4 or 5 ore bodies, one large open pit, a number of small underground mines. It is a world-class nickel sulfide district. It's got a lot of potential. I suppose it's like going into Kambalda sort of 50, 60 years ago, and there's nickel just outcropping everywhere. So we've defined a 10-year mine life, and we think that there's plenty more to be found. So at the moment we're focused more on the development phase, but we will go back to exploration and extend that mine life. So that's our main ore body. That's the Ban Phuc open pit. So you can see 265,000 tonnes of nickel in mining inventory. Large scale bulk open pit mining, 3-to-1 strip ratio. This is the base load feed for our refinery. Our mine will produce around 18,000 tonnes per annum nickel. So this is a large scale nickel mine, and that'll be 50% of the feed into our downstream refining business. This is the flow sheet of the downstream business. So you can see, well, the concentrator feeding in the concentrate from our mine and third-party feed. It's into a pressure oxidation process. This is a tried and tested technology used all through the mining industry since the 1960s. Then the solvent extraction, which is also a tried and tested technology. So there's nothing novel about this flow sheet. Very conventional, off-the-shelf technology that's used in not just base metals but also in gold, and we will combine that with the NCM technology. So the last stage where we convert the nickel and cobalt sulfate into NCM is a technology that we will combine with downstream partners. So we will work closely with downstream partners on that last stage where we combine the nickel and the cobalt and the manganese into the 811 product. The benefit of this downstream business is that it is very flexible. We have the ability to take concentrates that are not acceptable or not suitable for smelting. So for example, in the nickel industry, if you have a high arsenic ore or high arsenic in your concentrate or a high MgO level, you will potentially be penalised, or your ore might not actually be suitable for smelting. We can take all of those and more. So we can take your high arsenic ore or your high MgO ore. We can also take MHP, which is the product that is from the nickel laterite process. Nickel matte is another product that we can take, and black mass, which is the recycled product from the lithium-ion battery. So a very flexible flow sheet allows us to really arbitrage the market. So for example, MHP was a product that traded at high payabilities a couple of years ago, and now the payabilities are much lower. So for example, MHP trades in the order of sort of 60 to 70% at the moment, nickel concentrate around 80%, but 2 years ago MHP was in the order of 90 to 100%. So we can arbitrage the different markets and the different products throughout the nickel market. We've recently completed our pilot plant phase, so we spent 1,800 hours in the ALS laboratories. So this was a 12-month process. We invested around $10 million. So this is an important data set for our definitive feasibility study, which we're looking to complete over the coming months. We achieved better results than we expected, so our recoveries are actually higher than our pre-feasibility study. We have produced battery-grade nickel and cobalt sulfate, which we can now send to our partners for their testing purposes to sort of complete those discussions with the downstream partners. So it's an important couple of milestones to come. So the definitive feasibility study on the refinery and the mine over the next 6 months. Most importantly, we will look to lock in our partners. They will bring a significant portion of the capital required. We're willing to sell down up to 50% of the project for them to bring the funding required. Once we've locked in the partner, the debt will follow. So depending on where the partners are located, then the debt will be associated with those partners. Lock in the debt, lock in the equity and the funding, and then start the build phase over the next 6 to 12 months. So it's some big milestones to come, and what will be a significant re-rate as we achieve. Thank you.
Thanks, Scott. I am not yawning because I find your presentation anything less than scintillating, because I love following the journey. I'm yawning because I'm cold again. Is anyone else cold in here? Yeah, I've gone cold again. Can someone, one of my minions at the back, do something about that, please, in case the MC falls off the stage? Not that you want to listen to me. I know I can see you talking down there. We're going to go and talk now about battery materials. So something a little bit different to the straight minerals, battery materials. And Neometals is the story that we're going to take a look at. An investment proposition presented to us today by GM Jerry McManus. Jeremy has occupied a number of roles in the energy transition space, And I, for one, am interested to hear about vanadium recovery in Finland, a country we are yet to visit on this conference. Please make Jeremy welcome.
Chrissy, thank you for the introduction. Good afternoon, everyone. I hear that. It's slightly regrettable. I'm not going to talk about the VRP project, but maybe outside. What I am going to talk about is how Neometals is advancing from being a modest producer of very green battery materials to a large-scale producer of the same. We're doing things a little bit differently, and hopefully that shines out. So I'm going to touch on our battery recycling endeavours in Europe, and I'm also going to finish off talking about our remaining legacy upstream asset called Barrambie in Western Australia. So look, you know, we're an emerging producer of green battery materials. The production's coming out of our German recycling operations. We produce and sell both nickel and cobalt. We're headquartered in WA, team of about 40, AIM and ASX listed. And we've transitioned away from a heavy reliance on upstream minerals now to a situation where, you know, the business is very focused on 3 key mineral processing technologies which we've developed. And those processing technologies underpin 3 core business units. And so what we're looking to do is to source feedstock materials that someone else has dug out of the ground, apply those technologies, generate green battery materials, you know, and contribute to the energy transition. So very big sustainability focus, and we've had some execution success over the journey with our other projects, but that Venn diagram is those 3 business units. You know, and in terms of delivering on our strategy, you know, there's a few levers to success, 3 of which hopefully I can emphasise today. So the first is unparalleled exposure to the energy transition. And what I mean is a lot of shots on goal. That image to the right-hand side, the green bars represent the minerals that we have exposure to, those minerals that are most sensitive to the energy transition. And 4 of those 5 actually come out of the recycling project alone. We have very low carbon processes. We've designed and developed them ourselves, and that is hand in hand and lends itself to operating in the lowest cost quartile, which is a good thing. And then thirdly, flexibility of business models. So we're happy to act as principal, but ideally we work in partnership. We've got a lot of joint ventures, happy to share the economics, but equally we're happy to license technologies if our partner is big enough. So these pillars represent the business units. Let's park the one on the far left on recycling because I'll dive into that. But essentially what you should be taking away there is, you know, a desire to partner. Each of those projects are in joint venture. We've got some decent partners. We've also got a lot of brand validation from some of the companies that we're working with. So the idea is we get others to shoulder some of the burden and help co-fund. So in the middle, you know, I won't talk to these, but vanadium recovery, a technology to pull vanadium pentoxide out of steel waste. We're doing that in Scandinavia. Lithium chemicals, and happy to talk about these after, but lithium chemicals is a joint venture with MinRes, and that joint venture is partnering with Portugal's largest chemical company with a view to making lithium chemicals from brines using electricity to split the 2 from one another. Dashboard share price, regrettably, I'd like to turn that upside down, but fundamentally everything's going very well for us. You know, we've got circa 15,000 shareholders, market cap of about $350 million, you know, and board and management are the largest collective shareholders. Sustainability, I won't labour it, but it's core to what we do. Those technologies I mentioned really underpin, you know, and ensure a green outcome, and we're 4 years into disclosing what we do. So having a look at battery recycling specifically, this hasn't been an overnight story. It's 6 years in the making. Look, we started piloting in Canada. We designed the flow sheet for consumer electronics. Cars were coming along hard and fast, so redesigned flow sheet, drew the attention of a very big German plant builder called SMS, and we've since formed a 50-50 JV with them. So that's the vehicle for the global rollout. And really, Primobius is all about scale. We want to provide an industrial solution. This isn't a cottage industry. The graph on the left just shows you the sheer volume of battery materials available for recycling, and not just available, None of it can be landfilled. It all must be recycled, particularly in Europe. So blue bars represent scrap from production. Green bars, which is the real end game for us, where you get the economies of scale, are coming from end of life. On the right-hand side, what you're looking at is, initial target, studying a 20,000 tonne per annum facility. Look over to the left in terms of, 20 million tonnes at 2040, it's a drop in the ocean. But in parallel, we're studying 200,000 tonnes per annum. And essentially, this is an image showing you the flow sheet. It's really high level, but the concept is it's a two-stage process. So we'll take NMC and LCO chemistries in any format. We smash them up and chew them in a shredding and separation circuit. That's stage one. You pull out the plastic, the steel, the alloy and the copper foils. We sell it, it goes to a new home, and then that intermediate material that Scott mentioned, the black mass, you can either sell it, or better still, where we're going is refining it into individual metal salts. So we use solvent extraction, pull out the nickel, the cobalt, the manganese, etc., with a view to selling it back into the battery supply chain. So aside from the fact that batteries have a habit of wanting to catch on fire and they're hard to transport, there's a whole bunch of other tailwinds associated with this that help our business. And one of the big ones is regulation, particularly in Europe. You're seeing a situation where, there's now carbon footprint declarations, minimum recycled content, which keeps us honest as well in terms of how efficient we are at recycling. And the same goes, America's coming with similar, and the rest of the world likewise. Another tailwind for us is the requirement for jurisdictions to have resilient supply chains. The image on the left is all about having recycled content in your batteries, where you can't have it without recyclers. And on the right-hand side, what you're looking at is, at present, the situation is recycling just complements mine supply. But come 2040, this image looks at lithium, but come 2040, recycled content's going to have a really significant part in meeting demand. One of the other challenges for OEMs is around the fact that when they roll off the showroom floor, these green cars aren't quite that green. They have double the CO2 footprint of a combustion engine. Looking at my black Interceptor there, and the way to resolve that is, if you're a car maker, your next generation of cells that you make, if you use recycled material, that's when you start significantly reducing your CO2 footprint. So the economics, we're halfway through a process here. We've put out a cost study on the shredding, which is the stage one that I showed you in that image. And the stage two, the refining aspect, is due for sharing come June of this year. But the image on the right just shows you it's a lucrative business. So depending on your chemistry, the checkered line shows you just the spoke. We'll add to that when the hub numbers are out. But really, the real margins and the real economics come from doing not just the shredding, but also the refining. And so that's the end game, which is just as well because the regulators are insisting. So part of the uniqueness I mentioned at the beginning, those three key things. One of the big things is the business model itself rather than just the technology. And that's because we're happy to partner, which we're doing in Germany. We source the materials, we sell the products. We're happy to partner like we're doing with Stelco and Mercedes at present, and we're happy to license. So what I'm trying to say here is, unlike some of the competition who have a lot of money and are looking to commit to plants, and then they're figuring out where to get the feedstock second, which is pretty challenging, we're sourcing the partners first, they have the feedstock, and then we commit to building the plants, which we think is slightly less risky. So I mentioned SMS, the timing is right to bring on a big partner. They're a plant builder of significant repute. They're based in Germany, 140 odd years old, lots of footprint around the globe. They bring performance guaranteed plant. We brought the technology. So the images you're looking at in the middle, that's our recycling spoke in Germany. Right-hand side, that's the refinery, which is still at demonstration scale, but that got built through COVID, and we're showing people in and out of that facility every other week. So what this looks like in green, operational, is the images I showed you. That facility in Hilschenbach, Germany, it's 10 tonne a day, to give you a sense of scale. But then where we're going with the growth plan, we're building plants for both Mercedes and Stelco. Mercedes will be 10 tonne a day also, but they will be doing both shredding and refining, which we're helping them with and collaborating on R&D. Stelco are Canadian. They will do the same, but 5 times bigger again. And we're doing a study on our own site, potentially in partnership in a location in Germany. So this is all about scale. Just a little picture here showing you the shed is a euphemism for where they're putting the recycling plant. And the benefit to Mercedes, not just for the brand validation, is really about the cells that they have to deal with. So come 2040, they're going to have nearly 1 million tonnes globally of batteries that need dealing with. And I mentioned that we are initially studying 20,000 tonnes per annum. So there will be plenty of batteries. I'll leave this on the screen, but I think the key catalyst for us in the near term, first of all, we need a purchase order from Mercedes to cement that deal. They've had a groundbreaking event, so obviously we're very confident where that's going. That's imminent in this quarter, and then come the end of June to release that hub study. I think they're the 2 key things the market's looking for. So, look, early mover advantage, very sustainable technology and opportunity, lots of big partners, and the economics are terrific for this. So what I want to do with whatever remains of the presentation is just touch on Barrambie. So this is something that we have held, an asset, a VTM in Western Australia for a very long time. We've spent some $40 million on it, and it appears the stars are aligning right now with regards to the titanium price, and we have an off-taker in the wings. So just to remind you that it exists. So China's half of the global market for titanium pigment, and the challenge really is that those producers need chloride ilmenite feedstocks. They're in short supply, particularly from tier 1 jurisdictions, and the graph just shows you the price is going in the right direction, supply is constrained, and demand's increasing. So, this is an interesting opportunity where we now have an offtake in the wings. A bit of background on the project, on the left you can see where it is in WA. It's second only to Rio for titanium grade or resource grade, and it's all but permitted, ready to dig, and the missing link was the offtake. So we've recently signed a term sheet for offtake, looking to formalise it by the September quarter. So this is getting real for us. A few details on the offtake itself: 1 year of DSO, 4 years of what we call a mixed gravity concentrate, and really what this lends is for a very capital light, simple operation. DSO, MGC, and longer term we could do a little bit more concentration ourselves and get a better margin. But this image just shows how simple it is. You're mining, you're crushing, you're milling, you're going to the port of Geraldton and shipping to China. The Chinese are smelting as a blend feed, and they're creating an intermediate, a chloride slag, to make pigment or sponge titanium. So we did a PFS, and then the world changed with regard to this offtake, so we're updating that. Those numbers are imminent. So watch out for that. And the timeline here really talks to the new PFS that's coming and formalising that offtake. So as I leave that slide there, I think it's worth mentioning we've had this project for a very long time. It's being attributed close to 0 value in our market cap. We're pretty confident we can get an outcome for shareholders, and have long said we're doing a strategic review with a view to figuring out how best to return value to shareholders. So I just wanted to remind everyone that we haven't forgotten about that, and we're busy doing it.
Thank you, Jeremy. I'll have to come on my trip to Finland, up at the booth with you later on. It's a fascinating country, that one. Before we go to our final presentation in this session, number 8, and there's a good many of you in the room for this, and hopefully that means there's a good many of you in the room who have taken part in our poll. Let's stick that question up there for us and we'll see what the results were. We're looking? No. Oh, right, we've got it. So what sector do you think will see the most consolidation over the next 12 months? Was that the question? That was the last question, wasn't it? All right, so we've got lithium. Lithium is your answer to that one. All right. Are you ready for this? You've got a lot of energy. You're all ready for this one? And then we're going to go and take a little break, a short break for afternoon tea. So we're going to talk about the Hemi discovery, which is in the Pilbara near Port Hedland, correct? Making sure I've got this right. I don't want to, after taking Jeremy to to the other end of the earth, and he wanted to stay in Western Australia. We're going Hemi, Pilbara,
Yes.
Western Australia, right. So Hemi, if you know the story, they've grown over the last 3 years quite significantly. Started off at 2.2 million ounces. You've added 8.6, is that about 8.5 million ounces? Yep. So De Grey is pushing forward to finalise the DFS of how it's going to make its goal of building and becoming one of Australia's top 5 gold mines. How are they going to do it? Andy Beckworth, you're the man to tell us. Would you please make him very welcome?
Thank you, and I would just like to give you a bit of a summary on Hemi and where that's at this afternoon, but I also want to take you through some of the prospects that we think can then deliver more, and why we think there's a lot more to be found at not only Hemi, but also in the regional tenements we have. We'll go through the disclaimers. I would acknowledge the native title owners of the land we're working on. The big one there is Gary Yarra. We've just signed an agreement with them, mining agreement. That was a major milestone, not only for us, but for them. It was their first mining agreement. So that covers the majority of our gold resources and certainly all of Hemi's development project. So the corporate slide, basically $2.5 billion company at the moment, about 145 at the end of March in terms of cash, so we're pretty well funded. And I think probably the main thing here is 50% institutional investors, 20% with Gold Road, so it's a pretty tight shareholding and major shareholders. So, and as you can see there, currently I think we're about $1.50 something today. And we've been increasing from 4 cents when we first discovered it. So a major increase in value. Look, I'm not going to dwell on directors other than to point out Paul Harvey and Emma Scottney have joined the team in the last 12 months, and they bring a wealth of experience in their areas. And that's, one of the things we're doing is capability throughout the company from the board down. And on this slide, the new Peter Holmes, the project director, joined us recently. He's in charge of building Hemi, the plant, and getting it all done. So he's only been with us about 1 to 2 months and really getting very involved right now. Obviously lots of weight on his shoulders, highly experienced, built plants for Barrick over the last 10, 20 years, and importantly was heavily into the POX, which is part of our process. So what have we got? We've got the Mallina Gold Project. It's just south of Port Hedland. We're at 10.6 million ounces. We had 2.2 before we found Hemi, but Hemi has grown over the last 3 years by 8.5 million ounces. It is a very large gold resource, and it's of a different scale and a different beast to most gold deposits. We put out an ore reserve of 5.1 million ounces at 1.5 grams in the PFS last year. All these deposits remain open and there's lots of upside. We've just finished all the detailed DFS drilling, so all the infill drilling and all the metallurgical and geotech drilling. So we're pivoting now back to exploration, so the rigs will go back to finding more, which is, as an explorationist, that's the fun stuff. So we hope to be able to add to those resources as we move along. The DFS is very well advanced, and we're still on track to mid-year, third quarter, to put those results out. So where are we? We've just finished the PFS last year. We've been technically de-risking it with lots of metallurgy, geotech, and lots more infill drilling to beef up the resources to reserves inside the pits and maximise our reserve definition. Like I said, we've assigned the mining agreement, which is a major milestone. The mining lease application's in, and we've been talking to banks who are very interested in helping us along the path. So the PFS basically is summarised on this slide. We're talking about 500,000 ounces plus every year for the next 10 to 14 years at very good costs. All-in sustaining costs around $1,200. So large margins. The study was done at $2,400, and at $3,000 today's prices, there's even more margin involved. But the main thing to take away, this is going to be a big gold mine. It's going to jump us straight up into the top 5 at least, and we're looking to grow that. So this is what it looks like. Basically a cluster of about 5 deposits, 5 pits, and I just want to get scale across to you. Yeah, this is 3.5 kilometres by 2 kilometres. And in particular, I'm going to show you Brolga, the starter pit, and what that means. And the other thing is, drilling, these pits go to about 400 vertical metres, and the mineralisation continues. We just haven't drilled it yet. So you're going to see growth over the next decade of us going deeper, but also exploring laterally for other open pit deposits and extensions. So this is the Brolga starter pit. Basically, this is a slice through that Brolga pit. This section's 200 metres deep down to the red open pit you can see there. This pays for the whole project. This is the first 2 years mining. And the main thing to see here is the scale. This pit will be 600 metres long, 300 metres wide, and at some stages it'll be entirely mineralised on the floor, so which is very different. So to get that picture in your head, that's 4 times the Sydney cricket ground in length and 3 times wider. So it's a fairly big ore body, and that's just one of 5 in the cluster. So this is drilling. Obviously all the purple holes are all our resource drilling. Basically that's the pits. And what I'm going to show you now is the deposits, or the targets that we're going to test in the next 6 to 12 months along strike. So we've got about 5 big targets there. And I think the other thing to take away here is the scale of those targets in their own right. So we're obviously quite hopeful that some of those will produce more resources. But as we learn more geology, we're finding we can target much better, and yeah, we're very hopeful that we'll add resources in the near future. So I'd just like to take you through some of those targets, and then we'll work on to the regional targets. Dougal, it's already 1.6 million ounces. It goes down deeper already. Some of the intersections we've got at depth below the proposed pit are 360 metres at 1.2 grams, 75 at 1, another 70 at 1.4. And then we've got high grade within that. So there's potential for higher grade underground. And that's where things can ratchet right up very quickly in the future. So trying to put them in picture now. So on the right-hand side, we've got Dougal. That was basically what we were looking at in the previous slide. So obviously we've got extensions at depth. But Dougal Southwest is a pretty recent target of ours. We've recognised good rocks. We're getting some mineralisation there, and it's hardly seen a drill hole. And we can see another 1 million ounce potential there. So drilling's going into that one shortly. And then on the left-hand side, you can see Antwerp on the left-hand side of the diagram. That's another target, about 1 kilometre long. We're getting good results there, shallow mineralisation. And now we're just going to see if we can come up with another Dougal Eagle type style of mineralisation. And drilling's already underway there, so results will start to come out over the next month or 2 on that. Just sort of highlighting some of the numbers that are involved in the mineralisation we've seen on those 2 targets already. You know, we're getting things like 25 at 1, 6 at 5, 31 metres at 2, and others. And those are probably better than Eagle and Dougal when we first started drilling Dougal and Eagle. So skip to the regional now. So it's been lost in the last 3 years. We've not done a lot of work on the regional work because Hemi's taken such a focus. We've got 150 kilometres of tenure, and those red and purpley colours, they are our targets geologically, and we're going to be targeting a lot of those. We're trying to stay focused and take what we've learnt at Hemi and see if we can't advance our targets quickly. So I just want to take you through so you're aware of where the future might be. And a couple of those are just north of Hemi. You know, we've got the MBP, which is Mount Berghaus proper target. That is a zone of 15 kilometres that's never seen a drill hole. We have interpreted structure and intrusions in there, and we're drilling that right now. So that's a large target in its own right. And then just to the right of that, we've got the Mount Berghaus trend. It's also about a 15 kilometre trend. It's got a small resource there already. And we'll skip to the next slide and focus in on that a bit more. In the red box is where the only real drilling's occurred and our resources, and you can see the pit shells there. Those pit shells are restricted by how much drilling we've done. And all of that mineralisation to the west hardly tested it to date. So there's a lot more work that can go into here. And probably more importantly, to the east, which is off the slide, we've got recognition of new intrusions, which we have not followed up yet. So we see this area as another target for the next 6 months, 12 months. Skipping to the sort of west of Hemi, 30 kilometres, we've got the Withnell deposit. The yellow areas are the existing resource. They're part of the development process. The pit shell you see there is the current PFS shell. What we're finding is mineralisation in the red areas to the south. So that's quite wide-space drilling at the moment. And we see the Withnell resource potential being quite immense. And not only is it just there, there's about 7 kilometres mineralisation here, which we're reinterpreting and using our knowledge from Hemi. So we see enormous potential at Withnell in its own right. Now, Taurana is a special one. It actually led us towards Hemi and looking for Hemis. This roughly 500,000 ounce deposit, we've just done some infill drilling to improve reserves for the DFS. And we've drilled a few holes there. We've got, in particular, a nice high grade on the right-hand side there outside the resource, 41 metres at 4.7. That's actually a sub-vertical structure, we believe. Probably drilled down it, but what it does is open up a structural trend to the northeast, which we're going to track down sort of from the resource and further north. So some of the numbers we got in the infill drilling, pretty amazing. It's free milling. We've done some ore sorting. It looks like it's amenable to that. We'll do a lot more work on that yet, but that has the potential to improve economics for Taurana in its own right. Charity Well, it's basically a Taurana lookalike, but it's potentially 4 times longer, if not bigger. And I've put Taurana in a box there of the scale of the blue dot, so we can fit enormous number of Tauranas in this trend. We're getting good numbers. We've just finished drilling some air core on the eastern half in the black box, so we're waiting on those results. Those yellow targets are basically interpreted intrusions, but we're getting some pretty good results out of that. So have we got the potential for 1 million, 2 million ounces is the question. So where are we heading? Completion of the DFS is on our main focus, but we are pivoting that drilling out to the regional targets. The funding strategy is obviously high on our mind going forward. We're looking seriously at ordering long lead items for the development. We're building our capability, and we've talked about bringing in a director level and then the project director, but also at the lower levels, we're employing people at a rate of knots, basically. And we're moving the approvals forward. We're continuing exploration, and as I've tried to explain, we see multiple targets of million-ounce type targets, and we can see the resources growing, not only at Hemi and at depth, but out in the regional targets. So we see Hemi creating a top 5 gold mine for Australia, and taking De Grey forward rather rapidly. So currently it's about increasing those ore reserves and resources, building the confidence level, obviously the funding of that. It is a tier 1 gold deposit in a tier 1 area. Excellent infrastructure. We're right next to Port Hedland, right next to roads, right next to power. It's just very well located. So we're going to keep growing and build that deposit into a big mine. And that's pretty much it, but I'd just like to take one little thing and thank the team. Obviously you don't get all this done without people. This is our community relations team. They worked on all of them, the mining agreement, and now we have something like 100 people working out there. And so I'd just like to thank the contractors, staff, consultants. Without them, we wouldn't be here. Thank you.
Correct, Andy, you're only as good as your team. Well said, well said. All right, team, we're going to take a break. I'm going to give you 15 whole minutes, then we're coming back for the power team. We've got 9 power investing opportunities for you. You should be excited, Greg. It's going to be interesting. And then we've got drinks on Stewie. Okay, so let's make sure we stick around for that one.